In this lecture we are going to study an advanced trade situation that happened in the Euro-Yen 30-minute chart. This is a more advanced trade because it involves more subtle ideas like the sloped wash line and frequency lines as well. These are relatively simple things to grasp, but their application is not always obvious, otherwise they would be part of folk wisdom by now, and they are certainly not. The first thing you should notice here is that I have less than 100 candles on this chart, which is once again the proof that you don't need to go thousands of candles back to really understand what's going on. I like to say that price has a relatively short memory, which is obviously relative to the timeframe you are trading, but price does not seem to care too much about events that are way deep into the past, which is certainly a relief. This is a curious example because you will notice there is a market manipulation, but the whole maneuver happens within what we can call a normal flowing market. From number 0 to number 2, we have price making a lower low, which for all intents and purposes means downtrend. I suppose it would be really difficult to find someone that would disagree with that proposition in this situation. In point 2 we know that sellers have proven their ground. As you might be expecting already, this is not the interesting part of the analysis because it's too easy to notice that. Things begin to twist between numbers 4 and 5. Observe that after low number 2, price begins to naturally rise. I say naturally because regardless of the type of trend we have, the buyers and sellers are always alternating between energy accumulation and energy exhaustion. Number 2 is where the sellers were completely exhausted. That would explain why buyers started to pick the market up from that point, and also those longer lower tails around number 2. Those tails certainly imply buying pressure at that level, and this is something that will be useful later in the analysis. From number 2 to number 3 we can see price rising naturally as well, but since we are still in a downtrend, number 3 is far from breaking high number 1. Observe that around high number 3 we have the opposite situation that we had in low number 2. Buyers are now exhausting their accumulated energy, and sellers are beginning to take control of the market again. We can verify that subjectively by looking at the upper tails of the candles around high number 3. Those upper tails are implying selling pressure in that level. Let's take a moment to really understand why those tails imply that. A candle like that with an unusually large upper tail means that price was once high up, but sellers were strong enough to beat it down. Observe how that happened consecutively in 4 candles. After that, price begins to fall. If this is going to continue being a downtrend, price will have no problem breaking the low number 2 to continue its natural flow downwards. However, since things can never be that simple in the market, notice that this is not what happened in number 4. In number 4 we can see price action failing to break the low number 2, and this is something that sends a specific message to a certain type of trader, but remember that until high number 1 is violated, we still have a downtrend. I want you to pay attention to where exactly price lands and reverses in low number 4. As you can see, I drew a red horizontal line called frequency line that marks this level in a very specific way. A frequency line is a line that catches the common ground between several candlestick tails. This can happen horizontally or in an angled manner. This particular frequency line has its origins in low number 2. Observe carefully how the line ties all of those candles' lower tails, meaning that it cuts through all the candles' tails in a way that pinpoints their underlying frequency, hence the name of the line. That was a line that could be drawn right after low number 2 and way before number 3 and 4 were formed. Observe now the relationship between price and the frequency line in low number 4. Notice how price lands in that line, pierces it a few times and never closes below it. All that means is that the buyers that took control in number 2 are still present in that level in number 4, but the frequency line gives you a precise way of seeing it. As I said previously, the fact that price didn't break the low number 2 sends a message to the retail breakout traders, who are now certain that going long at the break of high number 3 is a good idea. We cannot run the risk of making such assumptions. That's why we first wait for price to reach that level, and then we can arrive at some conclusions. Needless to say, but at this point large traders are well aware of the retail traders' plan. We can see the first fingerprints of market makers in candle number 4.1, which is a volatile bullish candle heading directly to the high number 3. When retail traders see that candle they can't help themselves. Their level of certainty seems to get higher and higher. We are talking about the first leg of the manipulation at this point, which is the von Restorff effect. In this example the von Restorff effect is present, but it's not too explicit. Candle number 5 is where the fun really begins. Pay close attention to candle number 5 and what it represents for both market makers and retail traders. Large traders already knew there was a big order cluster at high number 3, so the conclusion that naturally follows is that by poking that cluster, an immense liquidity pool will open, and a market maneuver opportunity will present itself. That's exactly what happened in candle 5. When price was above the high number 3, many buy orders were triggered, and that means there was a huge opportunity to take the opposite side of that deal. The only group of market players that could realistically do that in an orchestrated manner are the large traders that we talk about in these lectures. The creation of the liquidity pool is a green light for them to get in the market with an astonishingly large sell position in this case. Notice the size of candle 5's upper tail. If you consider what we already discussed about what these tails imply, you will have no problem seeing there was massive selling pressure in that upper tail. When candle 5 closes, retail traders are either already stopped out or in a pure state of desperation. This is where the reverse psychology and bandwagon effect start to take place. It's a reverse psychology because they were triggered to the upside with one goal and one goal only, which was to actually trigger them to the downside later. The bandwagon effect bit of the manipulation happens because retail traders usually have little control over their emotions, and they want to recuperate their losses as soon as possible. The logical thing to do in their minds is to simply reverse their position as soon as they can. Ironically, this is what consolidates the market maker's position and makes it plummet to number 6. This means two things for us in this course. We now have a lower low than 4 and 2, which means that number 5 is a solid market structure on which we can rely. The second thing is that we have a manipulation level that will probably be respected in the future, so we can use it as a contextual element for a trade. There are a few more details I want you to pay close attention to. One of them is what happened with the upper tails of the candles surrounding high number 5. Notice that their frequency forms a short down-sloping line that I marked in red. This line has upper and lower limits, and the space in between forms what I like to call a press zone. Let's unpack the meaning of a press zone so you can understand what it means. Those descending upper tails around number 5 are the consecutive attempts of large traders to pound the market to the downside. In other words, they are pressing the market down. The funny thing is that this sort of thing usually passes unnoticed by 99.9% of the market, and yet it seems ridiculously obvious when you realize it. The press zone can serve the same purpose of a supply and demand zone in naturally swinging markets. Beyond that, we also have two special lines drawn after the manipulation took place, which is the horizontal wash line and the sloped wash line. The horizontal wash line, like we already saw in previous examples in the course, is fairly straightforward. It just marks the level in which retail traders were washed out of their positions and extends it to the future. The sloped wash line is a bit more complicated. The sloped wash line in this case is a combination of the horizontal wash line principle with the idea behind frequency lines. In other words, to draw a sloped wash line, we have to use the highs that were used as axes in the manipulation, and we have to catch the frequency of their upper tails. The origin of that sloped wash line is logically in high number 3. Notice how the line catches all of the upper tails. The second axis of the line is what is going to determine its angle. The second axis used here is of course the high number 5 where most of the manipulation occurred. We want to catch the frequency of those upper tails in high number 5 in a way that the angle does not take the line in high number 3 out of frequency with its corresponding tails. We also want to make sure that price does not close above the line at any point. We are only concerned with the frequency of the tails. If you follow all those steps correctly, the line you get is the one you see drawn in the chart. What happens between numbers 7 and 10 are the key to the short position you see in the chart. In number 7 we see price touching both the lower limit of our press zone and the sloped wash line almost perfectly. That's a good indication, but we usually wait for a bit more than that. In candle 8 we see an inside candle showing that price is making a temporary stop, which is something that agrees with the idea of short trade. In candle 9 price touches the sloped wash line and the lower limit of the press zone once again. We could have placed a sell limit order at the sloped wash line. That would be the most advanced way of getting into this market in a situation like this. However, there are easier ways to do that, and one of them would be to wait candle 10 close. Observe that we have a clear pattern here. We have two extremely precise touches in two very important lines followed by an inside candle each time that happened. The short position you see in the chart was opened at the opening of the candle next to candle 10. The stop was placed logically above high number 5, and the target is naturally 3 times as big as the stop to give us a nice risk-reward ratio. Let's take a look at how this market played out. Here you can see the analysis was correct and price went down far enough to trigger the take profit order in our short position.